with our class on trend trading or trading the trends. Now, trend following is perhaps the most popular long-term strategy in all the financial markets. As a trading strategy, it is exceedingly effective and profitable when the conditions are favorable. It's quite straightforward in its methodology, and there are many individuals, past and present, famous and obscure, who have used this strategy for success and riches. We should note that the technical aspect of trend following is in fact quite simple, but also that it requires, before everything else, discipline, sound money management, and patience from the trader. Trend following is not a short-term method, and patience and determination are as important as correct analysis as a result. But in order to follow the trends, we need to understand how a trend works. But remember, trends are created by powerful underlying economic factors, which may not be clear to all of those who are not very familiar with fundamental analysis. But the simple patterns created by the price action in response to economic events can often be identified through methods that are easy to learn and apply. Thus, the retail trader like you and I has as much potential of success as the most experienced analyst if he can control his emotions and behave logically. Now, to apply this strategy, we must first be aware of the existence of a trend. Now, many people think that a trend looks like this, but a trend is this. A well-defined, well-formatted trend is a series of peaks and eases, pushes and eases, pushes and eases, or higher highs and higher lows, higher highs, higher lows, higher highs, and higher lows. When you understand what a well-constructed trend should look like, you'd be surprised how easy it is to find them in the markets. Now, granted, my photo on this site or my creative on this site makes it look very, very easy. But what we're looking for, if we're looking to trend follow, is to find exact assets that are doing just this. Now, we're looking, I just popped up on the screen, a current gold price. It's a 1 hour chart on gold. And look at this, push, ease, push, ease, push. Lower low, higher low, lower low, higher low, lower low. Okay, a well-developed, beautiful trend. Okay. This happens quite often in the market, and because there are more assets than we can keep track of, finding one of the key things about finding a trade to follow trend trading is to find assets that are trending. So if we were just going to do, so we could simply look at the euro US dollar. It's almost following the same trend. But look at this climb when the euro US dollar was rallying. Push, ease, push, ease. That was a beautiful trend to trade. These happen quite often in the market, and locating them isn't so difficult because there are just so many of them that are available to us. So by simply going through that, now we can see here, light sweet crude oil, there's no trend. We just leave this asset. Yeah, there might be other types of trading opportunities. In fact, there was a big trading opportunity when the OPEC monthly report came out today, and the EIA report came out today. And look at how crude oil tumbled from the minute that report came out, from 73.40 straight down to 70.92. But that's not trend trading. There are other ways to trade those events, but for trend trading, we are looking for assets that are forming nice, well-constructed trends. Once we've located them, then we can then start figuring out when we can trade them, what to trade and what to do with them. So to apply this strategy, we must first be aware of the existence of a trend. Without identifying a trend, we would be gambling. And that's not the purpose of trading Forex. Both fundamental and technical analysis can be employed for identifying a trend. And both of them have their advantages and drawbacks. It is, in general, a good idea to use a combination of them to deciding on a trend's character and deciding on our entry and exit points. So, general observation of a market swing points is the first point to call in determining if a market is trending. If you do not see a pattern of higher highs and higher lows, or lower highs and lower lows, but instead you see sideways price movement with no obvious general up or down direction, then you are probably looking at a range-bound market or one that is simply chopping back and forth. And we move on. Okay. You shouldn't have to think too hard about whether a market is trending or not. Most traders make trend discoveries way too difficult. If you have a common sense and patient approach, it's usually fairly obvious if a market is trending or not, just by looking at the raw price action and its charts from left to right, just like we just did when I popped through those assets. Too many traders want to apply all different kinds of things. First and foremost, we have to just find an asset that is trending. If it does not, move on to the next asset, because if we can find it visually, okay, and make it easy, then we can start applying other things and other rules to it to decide whether we want to trade it. If you make it very complicated to find, you'll spend more time just searching for an asset that is actually trending. But you must choose whether you want to employ technical or fundamental analysis for your method, or a combination of both. Now, remember, technical analysis basically involves anything on a chart. So we were just looking at price movement on a chart. So what were we using? Technical analysis. Now, fundamental analysis can provide you with information which can predict the strength and length of a trend, while technical analysis can show you how it develops. It is possible to base your strategy on one of these exclusive to the others. Now, especially if you're looking at stocks, fundamental analysis will help you understand that much better, because if we see Apple moving up and we're getting good reports from Steve Jobs and we're getting new information about cell phone usage and computer sales, guess what? We can probably see that the asset is trending up. Now, technical analysis can suggest the beginning of a trend, but is unlikely to tell you much about the length or the strength of the same. Thus, I suggest that you use both technical and fundamental methods for your trend following strategy. With fundamental factors eliminating the false signals of technical analysis, and technical tools providing you with a time price frame for deciding entry points. Because once we found a asset that we think is trading, we want to look for an entry point, but we first have to decide on the actual existence of this trend. Now, There are many technical tools that can signal the phenomenon, but there are an equal number of false signals generated by them. Remember that there are only three kinds of trends that can exist at any time: flat, up, or down. Flat can be called sideways or congestion. And it is possible to speak of trends between any 2 points on a price chart. Simply take two random points on the chart and draw a moving average on it. And the pattern that arises can be analyzed. Now remember, there's a big difference between trends and trend lines. We are not talking about trend lines. We are talking about trends, which is the overall movement of a market. So imagine if we were looking at, instead of being in Forex, we were in automobile manufacturing. Well, what has been all the buzz lately? That the car dealers are discontinuing sedans because they could see that the trend was falling down on the sale of sedans and growing larger and larger on all-purpose and SUVs. So that's a trend, okay? And if we could see that the SUVs or the pickup trucks or whatever we're calling were growing steadily, that shows us the trend of the market. It doesn't give us a trend line. It gives us an overall trend. If women's heels are steadily getting higher and the skirts are steadily getting lower or longer, we can see trends. So a trend in fashion, a trend in manufacturing is no different than a trend in Forex or financial markets. Now, the trend we seek to trade is different from random fluctuations. Okay. Range patterns and similar price movements, in that the price itself, in the absence of any technical indicators, can still be recognized as showing a trend. Okay. In other words, there is some driving conviction behind the price action, which allows the trader to easily identify it visually. Depending on the type of trend, that is an up or a downtrend, successive highs and lows should constitute a rising or falling pattern. So here we see an actual candlestick chart. And what do we see? We see higher swing highs and lower swing lows. And we can see this well-constructed, beautiful trend. Now, one of the best ways to verify that you actually have a trend and not just a lot of movement all over the markets, and that you have a good trend, is simply by applying a moving average. A simple single moving average, because what a moving average is, it takes the noise out of the marketplace. And we can actually see how the price is actually moving. Because again, the whole part of trend trading is finding the best constructed, honest trend that you can find. Now, depending on the type of trend, successive highs and lows can constitute a rising or falling pattern with relatively few irregularities. But such a case is often a rarity, and the trader will have to back his technical patterns with conviction that can perhaps only be gained through fundamental analysis. Now, if the trend can be identified visually, why use technical tools? Even though we can notice the existence of a trend, we still need technical tools to trade it and time it. Because once we've actually seen this trend, because you're not doing anything, you're not putting any money up on the trend, you're simply identifying an asset that now you want to consider trading. Now, trending markets tend to make strong moves in the direction of the trend, followed by periods of consolidation or a counter trend retrace before the next leg in the direction of the trend. You will notice this pattern happens in almost any trend you find. Typically, what happens to many traders is they will make some money during the periods of strong directional trend movements, but then they will continue to trade as the market takes a breather from that trend and consolidates. It's these periods when traders give up all the gains they made when the market was moving aggressively. Now, when you find an asset that's trending, and because it should move down and then up or down and up and have these peaks and valleys, when it starts to form the valley or the retracement, you have three choices. You can stay in the market and hope it retraces and continues to downtrend, or the opposite. You can sell it each time that it starts to retrace and move to the sidelines and take your profit. Or you can set a point in which you will sell if a percentage, if it breaks a certain price level. But these are the only choices you have. Now, the thing is, when you're trading Forex or CFDs, you have to cover the spread, which can be quite wide and can eat up a lot of your potential profit. So a lot of traders don't want to buy and sell in and out of a trending market. They want to be able to ride it out. Me, I want to take my money, get in, make a trade, get out as soon as it starts to retrace. And what I look for are certain types of candles, and I will make multiple trades, because if I made 22 pips and my cost was 12 pips, I still netted 10 pips. And if I can keep netting 10 pips, 20 pips, 30 pips, and there'll be points where I'll have a bigger ride, okay, but I'm limiting my losses. Other side is you can use trailing stop losses. But first you need to identify the different parts of a trend, and this will help you over trading during a choppy or consolidation periods. It will help give you a chance of profiting when the trend makes a small move. So here we can see we have the push and ease, push and ease. A good trader who's trend trading wants to decide when it pushes up. Like I said, when I see this retracement, I'm not going to wait for this bottom out. I'm going to sell it about this level. If I got in the market here, sold out here, I'm happy. But that's me. That's my personality. A good trader wants to be able to stay in and ride that trade all the way up. Not to the very top, but enough to make a solid amount of pips. But the market moves in these spurts. And we can see that a trending market tends to move in spurts, moving in the direction of the trend and then stalling to take a breath before another leg, which are known as retracements. Now, these retraces are when we have the highest potential for a high probability entry within a trend. Now, the question is, where do you actually enter when you want to find a trending market? What gives you the entry point to enter? So often a market will retrace approximately the level of its previous swing point before the trend resumes. In an uptrend, these swing points are support, and in downtrends, they are resistance. Look at the first diagram for a quick refresher. So let's look at the chart we just looked at, but this time with the support levels marked. And so we have our support levels on here. Now we can use Fibonacci retracement levels, we can use pivot points, or we can use eyeballing to come up with these levels. But what we don't want to do is we don't actually want to enter a trade in the middle of the upswing. We want to look for the retracement level, and when it bounces off that retracement level, look for the entry point to get into the markets. Because what happens is you have a asset moving up here. You have buyers buying into the market. At some point, that market tops out. Not the trend. Nothing has happened with the trend. The buyers who bought earlier had, and especially the big buyers who said, okay, I'm looking to make 32 pips on this trade. And when that asset's moved up 32 pips, they've already set up their sell point, and they're selling off and booking their profit. Other traders who were buyers have moved to the sideline just saying this price has gotten too high. Because it takes a lot of force and momentum to push an asset up continually. So they moved aside. They haven't gone away. They still believe the price is going to go up. But with the buyers who are selling to book their profit, the sellers moving silent allows this asset to ease. Once it eases to a specific point, those buyers who are sidelined come back in the market and say, oh, this is a good level to buy, and they start moving the market back up. Okay, and they start pushing the market back up. So what can you use to support this decision as to where you want to enter the market? Volume. When you see the price move up and then retrace back off here, and you see the price bouncing off a support level and volume starting to increase, you've got yourselves an entry point. Because market timing is everything. Market timing never works when one is trying to predict reversal points on a technical basis. However, market timing in the context of a trend, with the purpose of picking the counter trend extremes and using them to enter a trade, is necessary and profitable. And therein lies the main principle of trend following strategy. Recognizing the trend, identify counter trend moves, and use them to enter a trade in the direction of the trend. So learning how to time your entry is crucially important. Now, there are many tools that will help you with this, technical tools. The best tools for trend following are supplied by moving averages and simple price charts. Bar charts and candlesticks, the right proper candlesticks, okay, will help you see that candlestick patterns, will help you see the trend is resuming. It's possible to use moving average crossovers or strategies like MACD. But whichever you choose, you should ensure that you do not complicate the main aspect of your strategy, which is simply trend following. You don't need to apply many of them. You can actually see this on your charts. Okay. Simply by using a moving average, and for Forex, a 10 period, a 9 period, a 30-day period, depending on what you're trading, can help you see when an asset is moving back to the trend, because you see the asset break above or below the moving average. So we can see on this chart, which is simply the euro US dollar, and we can see an entire beautiful strategy for trend trading. And look at this as we see price moving up and down throughout this trend's life existence. Now, we can use this with a combination of RSI breaking above the 70 level and below the 30 level to confirm it. We see consolidation. We give us the right candlesticks. We see our support and resistance zones. And we get our entry and exit points as we see the candles bounce off of the support zone. It's not very, very difficult. It's not overly complicated. It's clean and easy. So the next thing is, when do we take stop losses and take profit orders? This partly depends on the term and nature of your trend following method. A stop loss order can be placed a short distance above or below the trend line, whether it is provided by the moving average or a simple line drawn on a chart. In our opinion, the trend follower should not realize his profits until he has a good reason to do so. Now, that's if you want to sit and watch the market and the asset. The purpose of this strategy is to focus on underlying price dynamics by stripping out volatility and short-term movements. And there is little logic to realizing profits in response to fluctuations, which are irrelevant to the main action of the trend. Now, if you have the time to sit and watch, or you understand trailing stop losses, okay, what I do is as my asset moves in my trending direction, I'm continuously moving my stop loss closer. Hopefully to the point where I'm above profit level. So even if the market turns against me, I still end up in profit. But I still have to be aware of possible retracements. I don't necessarily want to get burned out if the asset is simply retracing as part of a movement. But if I've made enough pips, I don't really care. So this trading method involves a risk management component that uses 3 elements: the number of assets or contracts, the current market price, and the current market volatility. The initial risk rule determines position size at the time of entry. Now, all of us must have a risk management strategy, okay, built into our trading plan. If we have a risk management strategy, this will help us determine where we have to enter and exit trades and how much we can risk per trade, where we have to put our stop losses. It will help us limit the size of our position, because in order to, if you're only willing to trade you only have $200 to trade, you only want to risk up to $400, okay, you have to take a smaller position, which is a good thing. So exactly how much to buy or sell is based on the size of the trading account and the volatility of the asset. Changes in price may lead to a gradual reduction or increase in the initial trade. But on the other hand, adverse price movements can lead to an exit of the entire trade. So one of the first rules of trend following is that price is the main concern. Traders may use other indicators showing where price may go next or what it should be, but as a general rule, these should be disregarded. A trader need only be worried about what the market is doing, not what the market might do. The current price and only the price tells us what the price is and what the market is doing. Money management is a clear, decisive factor in trading the trends. Another decisive factor of trend following is not timing of the trade or the indicator, but rather the decision of how much to trade over the course of the trend. Because you can get in multiple trades and keep adding your position as a trend continues moving in the right direction. And then risk control, cut the loss is the rule. This means that during periods of higher market volatility, the trading size should be reduced. During losing periods, positions are reduced and trade size is cut back. The main objective is to preserve capital until a more positive price trend reappears. So remember, trend following should be systematic. Price and time are pivotal at all points. This technique is not based on analysis of fundamental supply and demand factors. The simple rules presented here are good enough to replicate the performance of many large name trend following hedge funds. So there's an old adage that says the trend is your friend until it ends. So remember, follow the trend, but keep calm. Don't panic when it goes into a retracement. Figure out what your rules of the trade are. Figure out how long you'll let the trade ride, how you're going to let your sizes, and let your risk management control you. But this one line pretty much sums up the quandary that traders are faced with when trading trends. While a bias has been exhibited in the marketplace and may continue, there's no such thing as a surefire trend continuation setup. So when the trend doesn't continue, the trader is often advised to look to mitigate his losses so that a reversal doesn't damage their trading account too badly. In an effort to be as precise as possible, many traders will move down to a lower time frame in an effort to get a more detailed look at the move inside a larger time frame. Price action can help traders diagnose and trade the trends. And indicators such as MACD, RSI, stochastic, CCI, and moving average crossovers can help confirm the trend and give you entry and exit points. Traders looking to speculate with the trend want to focus only on signals that move in that direction. So remember, trading a trend following system on a single market or only on a few different markets is suicidal. There may be long periods, even years, when there is no trends in any given direction or asset class. Well, because the markets have gotten so big now and we have so many opportunities, there's always something that is trending. But you'd be surprised, some days there's just nothing. Markets are all over the place. The key idea is to trade as many markets covering all asset classes at the same time. Trend trading is different than knowing assets. When you're trend trading, you're not really concerned with an asset's history. You're looking for a very specific development in a price chart. But the investment universe you choose will have a much greater impact than tweaking buy and sell rules. So choose wisely. You should choose a broad set of markets and avoid too high concentration in a single sector. In the long run, a healthy balance between all major sectors yields the best results. After all, the future is unknown and nobody has a crystal ball that will magically foretell tomorrow's price movements. But the fact of the matter is that biases do exist. Trends do take place, and in many cases, those trends may continue. The type of strategies are endless. It is possible to improve the return on a trend trading strategy by adjusting the face value of the trades according to the volatility of the underlying asset. In general, by reducing the face value at times of high volatility, the information ratio is improved. But remember, find your strategy, own it, keep it simple, and get it done. So on that note, we're going to say goodnight. Thank you very much for joining us. And again, give trade time an opportunity. Good night now.